Ever wonder what keeps the stock market from being a complete free-for-all? Well, today we're diving into the one law that basically tamed the Wild West of Wall Street, the 1934 Securities Exchange Act. Let's get into how it brought order to some serious financial chaos.
It's honestly kind of hard to imagine now, but before this law, the stock market was, well, it was nuts. This quote from the era really nails it. The ethical standards were substantially those of gangsters. I mean, wow. It wasn't just that it was risky, it was totally rigged. Prices were being messed with, and a handful of insiders held all the cards.
So, to really get why this law was such a massive deal, we have to look at what things were like before the rules. It all comes down to one catastrophic event that changed absolutely everything. $319 billion. In today's money, that's the estimated loss from the 1929 stock market crash. Back then, $25 billion just poof, vanished, kicking off the Great Depression. And this wasn't just numbers on a page. This was real life. We're talking about nearly half of America's banks failing and unemployment shooting up to almost 25%. It was devastating.
And, this crash wasn't some freak accident. This system itself was just fundamentally broken. Without any rules, everyday investors had zero protection, no way to get reliable information. Public trust in the market was completely shattered. It became obvious that something big had to change to keep this from ever happening again.
So, out of the ashes of the Great Depression came this pretty radical new idea: regulation. The government decided it was time to step in and basically become the new sheriff in town. And you have to understand, this was a huge philosophical shift. For decades, the approach was laissez-faire, hands off, let the market do its thing. The 1934 Act was a complete rejection of that idea. It established a brand new principle. For markets to be truly fair, you need a referee to enforce the rules. And that referee became the Securities and Exchange Commission, or as we all know it, the SEC. This independent agency was created by the Act, and it had a very clear mission: protect investors and maintain fair, orderly, and efficient markets. All right, so we've got this new sheriff. What rules did they enforce? Let's zoom in on one of the most famous and fundamental prohibitions: insider trading. At its heart, this is all about fairness. Insider trading is illegal because you're trading based on material, non-public information. That's just a fancy way of saying important stuff the public doesn't know yet. It gives you an unfair advantage. It's like knowing the winner of a horse race before you place your bet. Of course you're going to win, right? Okay, so that's the definition, but what does a real case actually look like? Let's break down one of the most high-profile examples you've probably heard of. This case is a perfect illustration. In 2003, Martha Stewart's broker tipped her off that the CEO of a company she owned stock in was selling his shares. So she acted on that tip and sold her own shares, just one day before the company announced bad news that sent the stock price plummeting. She got out safe while everyone else took the hit. That's the exact amount of money Martha Stewart illegally avoided losing. Now, for a celebrity, that might not sound like a crazy sum, but it's the principle that matters. As the SEC director said back then, it is fundamentally unfair for someone to have an edge on the market just because she has a stockbroker who's willing to break the rules. And the consequences are very real. This law is not a suggestion. Breaking it can lead to huge fines, civil penalties, and even jail time. It sends a really clear message: no one is above the rules. But the 1934 Act wasn't just about punishing the bad guys. It was also about preventing this kind of stuff from happening in the first place. And the key to that was one word: transparency. The Act makes public companies file regular reports. You can think of them like a corporate report card. The big one is the 10K, a super detailed annual report with financials that have been checked by independent experts. Then you have the 10Q, which is a quarterly update, and an 8K has to be filed if any major unexpected event happens. The whole point is to give every single investor access to the same crucial information at the same time. And the transparency doesn't stop there. Companies have to send out proxy statements so shareholders can actually vote on big decisions. Anyone who buys up a big chunk of a company, more than 5%, has to declare it publicly. Even legal trading by insiders has to be reported. It's all about leveling the playing field and giving the average person the tools to make informed decisions. So you might be thinking, a law from the 1930s? That sounds ancient. How does it stay relevant in today's high-speed digital world?
Well, the SEC is constantly evolving. For example, it's created rules for crowdfunding to help small businesses raise money online. And back in 2013, it even clarified that companies could use social media to announce important info as long as they tell investors which channels they'll be using. The tools change, but that mission of fair disclosure stays exactly the same. The federal law also has partners at the state level. They're called blue sky laws, and they got that name from a Kansas official way back in 1911. He was fighting fraudulent investments in things like fake mines, which he said were backed by nothing more than the blue skies of Kansas. It's a great reminder that this fight for investor protection is over a century old. And that brings us to today. The core principles of that 1934 Act, fairness and transparency, are being tested by things like crypto and meme stocks. So the big question really is, can these foundational rules adapt and keep the market's Wild West days from ever coming back?